Most people think oil companies make money when prices go up and struggle when prices fall. ConocoPhillips is built to break that rule. This is a company designed not for hype cycles, not for short-term oil spikes, but for survival, cash generation, and dominance across decades. And once you understand how ConocoPhillips is structured, you'll see why it's often described as one of the safest and most disciplined oil producers in the world. ConocoPhillips is one of the largest exploration and production companies on the planet. Unlike integrated oil giants that refine fuel or run petrol stations, ConocoPhillips focuses almost entirely on one thing: finding oil and natural gas, pulling it out of the ground efficiently, and turning it into cash. That focus matters. The company operates in more than a dozen countries and controls a massive portfolio of oil and gas assets. But its real strength lies in where that oil comes from and how cheaply it can be produced. ConocoPhillips has positioned itself around some of the lowest cost oil resources on Earth. Its crown jewel is the Permian Basin in the United States, one of the most productive and profitable oil regions ever discovered. Over the years, ConocoPhillips aggressively expanded its footprint there, most notably through the acquisition of Concho Resources and additional assets from Shell. These weren't flashy deals, they were strategic. By consolidating scale in the Permian, ConocoPhillips lowered its average production cost to around $40 per barrel, with many assets producing oil far below that level. That means even when oil prices fall sharply, the company can still operate profitably while higher-cost competitors struggle or shut down production. This is the foundation of the entire business model. Because ConocoPhillips doesn't need high oil prices to survive, it doesn't gamble on them. Instead, it focuses on consistency. It drills only where returns make sense. It avoids overextending during boom cycles, and it prioritizes cash flow over production growth for growth's sake. That discipline shows up clearly in how the company treats its investors. Rather than pouring every dollar back into expansion, ConocoPhillips has made a clear commitment to returning capital. The company plans to pay a steadily growing base dividend, buy back shares, and distribute additional variable cash returns when excess free cash flow allows. In other words, when oil prices are strong, shareholders get paid. When prices are weak, the company stays financially intact. This approach reflects a broader shift in the energy sector. For decades, oil companies chase growth at any cost. ConocoPhillips has moved in the opposite direction, focusing on balance sheet strength, capital efficiency, and long-term resilience. And that balance sheet matters more than most people realize. ConocoPhillips consistently maintains one of the strongest financial positions in the exploration and production space. It carries low leverage relative to peers, holds significant cash reserves, and maintains one of the highest credit ratings among oil producers. That financial flexibility allows it to weather downturns, fund operations internally, and avoid dilutive emergency financing when markets turn volatile. This is not an accident. It's the result of deliberate planning in a world where energy demand is changing. The company openly acknowledges uncertainty around long-term oil demand. Rather than ignoring that reality, ConocoPhillips has structured itself to thrive regardless. Low-cost assets, conservative spending, and disciplined capital returns allow it to remain profitable even in a slower growth energy future. At the same time, oil and gas are not disappearing anytime soon. Global energy demand continues to rise, emerging markets still require reliable fuel, and renewables alone cannot yet meet baseload needs. ConocoPhillips sits in the middle of that transition, supplying energy efficiently while prioritizing shareholder value. That combination is why many investors view ConocoPhillips not as a speculative energy play, but as a defensive cash-generating machine. It's not the loudest oil stock. It doesn't promise explosive growth, but it does something far more important. It survives, adapts, and pays. And in an industry known for boom and bust cycles, that may be the most valuable advantage of all. Thanks for watching Finance Spot. If this breakdown helped you understand the company behind the ticker, make sure to like the video and subscribe for more deep dives into stocks, sectors, and market-moving businesses. This is Finance Spot, and I'll see you in the next one.